So far in 2023, Mr. Cooper has announced two major acquisitions, including HomePoint Capital and Roosevelt Management Company. With these two deals, Mr. Cooper is that much closer to its goal of managing over $1 trillion in mortgage servicing rights, which we're going to refer to in this conversation as MSRs. I'm Clayton Collins, CEO of HW Media, and your host for the Housing News Podcast. Today's guest is Mr. Cooper CEO, Jay Bray. Jay talks about these two acquisitions and why the Roosevelt deal may in fact be a game changer for the servicing space. We go deep into MSR valuation and the trends worth watching with independent mortgage banks and depository lending institutions that are retaining and selling MSRs. I hope you learn as much as I did from this conversation with Jay Bray. He really drops a lot of expertise and knowledge, and I am so grateful for his generosity on what he shared today. I hope you enjoy the conversation with Jay Bray, CEO of Mr. Cooper.
We may have just gotten back from Gathering of Eagles, but we're not done with events for 2023 yet. This October, we're headed right back to Austin, Texas for HousingWire Annual, and we want to see you there. We've got a power-packed agenda with content such as our Women of Influence speakers, peak performer playbooks, CEO playbooks, and more to propel your company forward, as well as a bunch of networking events. Because this event is open to real estate executives, mortgage, title, and everyone in between, you really have the opportunity to network with people from all across the housing ecosystem. If you want to learn more about the event, or if you're already ready to get registered, head over to HousingWire.com on the events tab and you can learn all about it. Not to mention, if you're an HW Plus member, you're going to get 50% off your ticket. So get registered for HW Plus and get registered for the event so we can see you out in Austin.
Jay, welcome to Housing News. Thrilled to have you today.
Thanks, Clayton. Very glad to be here. Appreciate you having
Jay,
me on.
When we booked this conversation and put it on the calendar, I was excited from day one. We have a multiple time Tech 100 winner for Mr. Cooper, a HousingWire industry vanguard in you. But to be completely honest, it's gotten even more exciting for me since we booked it, because you are now my personal mortgage servicer, which you weren't.
I love that.
So I'm now officially a Mr. Cooper customer through the acquisition of HomePoint Capital. So I'd love to, kind of kick off and learn more about what my mortgage servicer is up to in the acquisition strategy. I'm just kidding around, but I do have a mortgage with you. So Jay,
well, you're
let's kick off.
Some feedback along the way as you experience the journey.
I will. I'm going to reach out to you directly with issues.
I like it.
All right, Jay. So busy year. You guys have you're navigating this mortgage market that's had its ups and downs and lots of change. At the same time, put a couple new acquisitions under the belt with the announcement of closing the HomePoint Capital acquisition and Roosevelt Management Company. I think the HomePoint deal has gotten a lot of attention in the industry. So can we start there? Tell us about that acquisition, which you just announced in August, but we know has been in the works for quite a bit longer than that.
Sure, absolutely. Glad to talk about it. HomePoint, we've known the management team there well. Know the Stone Point folks really well. We've talked to them kind of, over the years about different strategic options. And as we entered the year, we felt like that there was going to be an opportunity to buy, some MSRs, and HomePoint presented a wonderful opportunity. I mean, they had a large portfolio, predominantly Fannie Freddie, and really fit our wheelhouse. And we just felt like, that made a ton of sense, and we could add it to our platform, without a lot of incremental costs, and continue to grow the platform, that we've discussed, over the years. And so it made a lot of sense for us. And it's been a smooth process so far. We've gotten the approval to actually close on that. We did close on it, and we'll board it here in the next, couple quarters. So really, really excited about it. And strategically, it just made a ton of sense for us because it fits so well with the platform.
What's different about acquiring a a business or the assets of the business like HomePoint Capital versus buying an MSR portfolio in a different type of transaction? Like how does the complexion of this deal look in difference of just buying an MSR portfolio from an IMB in terms of deal structure and integration and all the considerations of M&A?
Yeah, this one is pretty simple because what HomePoint had done over the last, call it year, is they really had simplified their operation. And so, once we got to the stage where we were able to execute on a transaction, really, Clayton, all that was left was predominantly the servicing asset, and the servicing asset was being subserviced. So they just didn't have a ton of, operations, a ton of people that were, supporting that asset. So it was almost like buying an MSR asset. If you contrast that, with, call it Roosevelt or a Pacific Union transaction we did a few years ago, there you're actually buying the company and you're buying the people, you're buying the platforms, et cetera. Obviously, that's much more complicated. And so there you have to go through an integration process. You have to integrate the team members, integrate the systems, et cetera. And so, our we've done more, I would say, asset transactions than really true company or platform transactions in the past. We can certainly do either, but the complexity of HomePoint was pretty simple because they had really, simplified their operation. So that's really the way to think about it.
So at that stage in HomePoint's journey, there wasn't a lot of human capital coming with the transaction. Assets were being subserviced. Do you pull the servicing rights into Mr. Cooper's servicing capability, or do you keep the subservicer around? How does that transition work?
No, we typically pull the subservicing into our platform. We view our platform as, if not the most efficient, one of the most efficient platforms out there. And so with our scale, our size, our profitability, it always makes sense, to move it onto our platform. Now, there may be a period of time that we keep it at the subservicer just from a, logistics standpoint, approval standpoint, et cetera. But we generally always move it to our, platform.
Have there been any like surprise challenges with the integration of the acquisition so far, or maybe the other side, any opportunities that have been uncovered?
I don't think there's really been any surprises. I mean, we typically do quite a bit of diligence coming into, these acquisitions, and so I think everything's gone extremely smooth. Certainly on HomePoint, again, it's a pretty straightforward and simple. On the Roosevelt Rushmore transaction, again, I don't think there's any surprises there. Strategically, with Roosevelt, we think there's a lot of opportunity to, raise third-party capital to eventually to deploy into future MSR acquisitions. So, we're really excited about that. I mean, we're in the early innings of that, but we really looked at kind of the Roosevelt Rushmore deal as acquiring the Rushmore platform gave us, even more special servicing capability. And that market obviously is in a little bit of disarray. And so we view that as a real opportunity. And then with Roosevelt, we got a registered investment advisor that will be able to raise third-party capital. And we're excited about that. I'd say we're in the middle innings there, so we still have a ways to go, but super excited about it.
So on the Roosevelt deal, so Mr. Cooper, already a public company with access to public equity markets. I don't understand how like the RIA brings additional access to capital. Can you give us a walkthrough of how owning a registered investment advisor, an RIA in Roosevelt increases your access to capital, already being a publicly traded company?
Yeah, it really, what it does is, even though we're public, it's a bit inefficient to continue to tap the equity markets, for MSR purchases, if you will. You can do it, but you dilute your existing shareholders. It's the cost of capital is sometimes prohibitive, and so this just gives us really a permanent capital vehicle that we can continue to raise additional funds or continue to add to a single fund, and just makes it, it's a more efficient way to do it, we think, and frankly, both from a cost and a process standpoint.
Okay, so like Mr. Cooper as the publicly traded entity kind of operates as the opco, and then you can use the RIA to launch and raise capital in funds that are specific to like a certain MSR tranche or acquisition or subsidiary.
That's exactly right. That's exactly right.
Okay, all right, really interesting. And then does Roosevelt have an employee base of investment advisors across the country who can like kind of act as a distribution tool for those funds, or how does that work?
They do. They have a small team that has raised capital in the past from third parties, and so we'll retain that team and are working with them as we speak to kind of map out what the plan is with respect, which investors do we want to go talk to, what investors have they used in the past, and ones that we're familiar with as well. And so yeah, we'll retain that team and really use them as the fundraising arm for that vehicle.
Interesting. So before the Roosevelt acquisition, were you using public or private equity to fund MSR purchases, or did you already have some type of fund structure that was inside of the business for different purchases or tranches of MSRs?
Really, historically, I would say the majority of capital that we raised for MSR purchases was through the unsecured debt market. And
Okay.
so, if you look at, I'm trying to think, I think I raised our first debt in 2010. And so it goes all the way back to that time period. And so, over the years, we've tapped that market and predominantly used those proceeds to acquire MSRs. And then I'd say additionally, we use our own cash flow that we generate in the business. We redeploy that, or certainly a piece of that back into acquiring MSRs as well. So those have been the primary sources historically, and it's worked well. I mean, it's worked extremely well. And if you think about some of the other platforms out there, they'll have a third party capital vehicle. They might be a REIT, or they might have a partner that's a REIT, et cetera. And so, this is just another way for us to it's kind of a second or third leg to the stool from a capital raising standpoint.
I mean, it sounds, I feel like calling it a second or third leg might be kind of underselling the importance. I mean, the industry has given a lot of focus to the HomePoint deal because HomePoint, as an originator, had more of a brand and awareness of what the deal was, and like the massive size of the servicing portfolio that was coming into your business. But it sounds like Roosevelt might actually be the enabling capability that enables you to continue to scale and increase your like already like market leading scale and scope of the servicing portfolio. It's like something that's like hasn't even been seen before in the industry.
Yeah. No, I think that's right. Look, Clayton, I mean, we have a balanced business model today, right? We have the origination business and the servicing business. And the servicing business, just to give you a kind of a scope for that, it's around, I think at the end of the second quarter, it was around 850 billion. We were the third largest servicer in the country, largest non-bank servicer, and candidly, I think we'll move up the ranks with HomePoint, with some other acquisitions. We'll probably be number two, and with number one selling assets, we may eventually be number one. And so it's a massive business for us, and it's in this part of the cycle, it has been extremely profitable, and it's really our balanced business model is kind of proven to be a real strength of ours. And to your point, this is just going to be another catalyst to continue to grow that business. And look, I would love to dominate the servicing business for years to come, and I think we're well positioned to do that.
All right, so I want to hear more about the profitability, but let's hit on the balanced business model first. So, can you give us a glimpse into how the legs of the stool work together, how origination and servicing, how origination works inside of a servicing centric business? Give us a snapshot of the Mr. Cooper business model today.
Sure. Yeah, I mean, we've always been in the origination business. Obviously, are well known for our servicing business. And for us today, the origination business is still servicing centric. Our largest channel is our direct to consumer channel. and that channel is predominantly focused on our portfolio. So we're trying to take care of our existing customers by offering them any type of origination product that they need to meet their needs. And so, if you go back to 2020, when rates were certainly in a different place, I mean, that the origination business, was making over $1 billion a year, and just by retaining, our existing customers. And so it's a very, very powerful machine. And we kind of measure it based on how many of our existing customers, do we keep? Like we call it recapture or retention. And, we are, at least in the refinance world, over 80%, 85% recapture for our existing customers. If you have refinanced with us before, that number goes to 90 to 95%. And so, it's a real powerful engine, within our business, and provides that balance. And then in addition to direct to consumer, we're in the correspondent business. We also, buy MSRs through co-issue. And so those are kind of the different pieces of the origination business. And correspondent, we're, a meaningful player there, but we're also pretty disciplined in maintaining our returns, and we just, again, view it as another way to acquire customers. But really the balance is the beauty of it, because in this rate cycle, you've kind of seen what we've been able to do. We've been able to continue to generate significant cash flow, significant earnings. I think kind of exceed the marketplace's expectations because of the servicing business. Now, if the cycle turns, obviously we're investing in the origination business even more today, so that we're ready for the next cycle and can recapture or retain those customers when it makes sense.
So at a loan level, so you have a borrower, a loan in your servicing portfolio. From a profitability perspective, it's best, these are my assumptions here, it's best just to keep that loan performing in the servicing portfolio. But if they're a candidate for a refi, or they're going to do a refi for one reason or another, the origination business helps retain that borrower, because it's better you than somebody else, where you lose the client and lose the loan out of the servicing portfolio together, right?
That's exactly right. Yep.
Okay, so
that's exactly the way to think about it. Yep.
So like
today,
would rather the loan just stay in the servicing portfolio and keep performing, but if it's going to refi, it better be with us.
Exactly. 100%. Yeah, that's right. And if you think about today where, the coupons are within our portfolio, there's millions of our customers that are in that 2.75 to 3.75 interest rate range. And so they're not going anywhere. I mean, there's really, no reason for them to go anywhere. And so I think they'll be in the portfolio for years to come, which is great.
Do you have a feel for like what percent of the portfolio is under 3% or under 4% or under 5%? Like kind of knowing some of the thresholds of where like refi risk or refi opportunity really starts to pop up if interest rates come down to a certain level?
It's significant. I mean, I think it's over half is kind of, interest rates would have to come down, 1.5% to 2% for there to be any kind of meaningful retention or recapture opportunities. And so, and meaningful is a relative term. I mean, that still would only be, call it a quarter of the portfolio, or even a little bit less.
Interesting. So you did mention though, you're investing in the origination business. What does that investment look like? Is that people? Is that tech? Like what do you do to prepare the originations business for an eventual opportunity?
It's predominantly tech and kind of process automation. I mean, we're really looking at every step of the origination process and, trying to make that more efficient from a team member standpoint, make their job easier, as well as from a customer standpoint. So we have something that we call Project Flash, and Project Flash is really focused on the processing piece of the business, and really taking the steps, that a processor goes through to get a loan from, application to closing, and really automating as much of that as possible, and really making that more task focused as opposed to, just one person kind of, does everything, and really taking that into bite-sized chunks and making it, again, a more efficient and effective process for the team member and the and the customer. And then I'd say the other area we're looking at is what we're calling sales modernization, and that is really trying to make the mortgage professional or the loan officer's experience better as well. Today, they have a pricing engine, they have an underwriting engine, they have kind of an application engine. So how do we make all that work, in a more efficient, effective way? So that's a couple of examples of where we're
So
making investments.
Project Flash is that still a human capital centric innovation? So we're breaking apart the processing process into core pieces. So is that creating like assembly line type specialization, or is there technology that's taking on some of those specialized tasks?
It's a combination, but it still is human capital, predominantly. But it's a combination of where we can automate, we'll certainly automate, and where we can't, obviously we'll have, some specialists working on that piece.
Interesting. Okay. So Jay, the industry has been through turmoil, specifically on originations. We're looking at a significantly different volume and volume landscape than we were 18 months ago. But MSRs have performed well, and you mentioned the profitability that you've been able to drive for the business and shareholders. Give us a glimpse into how the servicing business, maybe not specifically Mr. Cooper, but like servicing business as a whole, performs in this type of market cycle, and the considerations you have, and like how you invest in different parts of a cycle.
Yeah, the simple way to think about it, you touched on it earlier, Clayton, is that a big driver of profitability is you don't have payoffs, right? Amortization expense is always going to be a, significant expense in the P&L, and that has evaporated, right? It's really shrunk to, a very small number. And so that in and of itself, in this environment, certainly helps profitability in a meaningful way. The other area that we're crazed about is, the cost. And just like on the origination side, how can we continue to deliver a better customer experience in a cheaper way? And that's where I think ultimately, Mr. Cooper is separating itself kind of from the rest of the pack is, we are just driving efficiency, and we're looking for more and more opportunities to drive efficiency. An example of that would be in our call center, where we're using different tools, some AI tools, some ML tools, to really automate a lot of the process. So if you're a customer, you're going to experience some of this, and you call in to the service center. We're going to allow you to self-serve for almost all of your needs. And if you have a more complicated issue, or you want to talk to, one of our representatives, certainly you'll be able to do that. But the digital tools that we have now and the capability that we have within the call center, it gets better every month. And so we see massive opportunity to continue to make that better. And that's where we're making a lot of the investments is right there.
I see a lot of people who've launched AI tools come up with some cute name for the tool for consumer interaction, the Alexa at Amazon, or my friend Tom Ferry just launched Tom.ai, so his coaching clients can talk to Tom.ai. Is Mr. Cooper going to be the moniker, or is there some other cute name for AI inside of the servicing world?
I think we'll stick with Mr. Cooper, or maybe an abbreviated
Coop. That's cute enough.
Folks.
I'll never forget when I acquired HousingWire in 2016 and came into the business. It was about the same time, shortly after, that one of our journalists latched on to this rumored rebrand of a large servicing company in the DFW area to Mr. Cooper. But man, that rebrand stuck. It doesn't even sound weird anymore. It sounds like I don't know. It's a good.
Yeah. It was, look, it was a bit, obviously people were a little shocked at the time, but as I reflect on it, it was a great moment for the company. We had, originally we were part of Syntex. Syntex was a large home builder in Dallas. Then we were acquired by Fortress, a private equity firm, and rebranded to NationStar. And really the company through the last crisis, 2008, grew significantly on the servicing side and really helped a ton of homeowners stay in their home. That was kind of what we were known for. I mean, the GSEs really approached us to help them, but we were very, I'd say, operationally focused, very acquisition focused. And the rebrand, it was a reflection time for me and a reflection time for the company. Like, what do we want this company to really stand for? 10 years from now, 15 years from now. And that's how Mr. Cooper was born. And it really wasn't as much about the name as it was, we want our team members to be advocates for our customer. And we want it to be personal. And so we did a lot of work around it, and we went out and talked to different lending institutions, financial institutions, customers, and we said, "What do you like about your mortgage servicer?" Right? And it never was, oh, we love whatever. It was always a person. They're like, "We love Clayton because he just helped me, get a modification. He helped me stay in my home." Or, "We love Clayton because he helped me refinance and save $400." And so, we wanted to personalize it, and that's really how Mr. Cooper was born. And so, as you talk to any of our team members, I mean, they know what Mr. Cooper stands for. They know what our values are. And, it's really a rallying cry for our customers. I mean, how do we take care of them and be advocates for them? But you're right. It was a shock, and I remember going to talk to Fortress about the name change and thinking maybe I'm going to get thrown out of the office, but they were 100% supportive, and it was great. It's really been a great journey, really great journey.
Yeah, in hindsight, it definitely feels like the right decision, and has made a cultural shift from the external perspective. It feels like there's been a cultural shift with the brand. So Jay, let's shift over to MSRs, and we know that MSR values have performed well in the last few years. Can you explain to me some of the drivers behind MSR values and like the industry dynamics of the time that consumers keep their loans and interest rates? Like, what drives value, and how do you think about the market dynamics that are positive for MSRs?
Sure. I mean, I would first say, Clayton, that we think, given where we're at in the cycle, and we've talked about this on a couple of earnings calls, that we think there's going to be more MSR coming to market than perhaps we've ever seen. I mean, we've said we think there's going to be $4 trillion over the next 2.5 years of MSRs that are going to come to market. And that's because of what, some of that is just the origination environment. Originators can't afford to keep the servicing. Some of that is, originators are not profitable enough now to keep the servicing that they originated in the past. And then some of that just is what's going on with the banks. And
just for context, you earlier said that you're about 850 billion in servicing right now.
That's right. Yeah.
So there's like an opportunity, not that you're going to win all 4 trillion of it, but like there's an opportunity to grow the business by multiples.
Absolutely. And we've again also said that we think, our goal is to hit the $1 trillion mark. There's, nothing magical about that, but we think that's an aspirational goal, and we think we'll hit it. And so, certainly we'll hit it. We believe in, if not this year, next year. But to answer your question on the drivers of the MSR kind of profitability and performance, certainly prepays, are a big function of that. So how quick, does a loan pay off? And again, in this environment with, kind of the coupons, at least in the legacy, call it 22 and before vintages, you're just not seeing a lot of prepayments. So that's driving tremendous value. Delinquencies, certainly that is a big component of value as well. And again, the housing market's healthy, right? And people have more equity than they probably had, ever before. And so those two, and they're employed. I mean, when you look at kind of where employment's at, it's still very, very, strong. And so those factors, probably are the two biggest drivers of the economics around an MSR. And then there's other nuanced things like, float and ancillary fees and things like that. But the biggest drivers are speeds and delinquencies.
So there's obviously like economic cycle trends and housing cycle trends, but there's a few long-term trends that are out there. So we've had this kind of multi-decade trend of interest rates reducing until this like most recent point where they've shot up at a historical pace. And then we also have a trend in the last a decade or so, where the average homeowner has stayed in their home for 5 to 7 years, has increased up to double digits. How do you think about those kind of secular demographic trends impacting MSRs? And like, do you underwrite any like reversals and like the demographic trend of staying in a home longer?
Well, I think our view is, again, it's every loan is unique, so it's going to depend somewhat on the market, the current coupon,
Yeah.
so there's always factors that are going to go into it. But if you think about it long term, look, I think there's not an easy fix for the supply answer, right? There's not enough
Yeah.
houses out there. There's housing still, to me, is a local kind of regional type business, and so there's no overarching solution that's just going to immediately fix the supply problem. So I think from a long-term kind of secular standpoint, you're going to continue to see people stay in their homes longer, and I don't see that trend really changing. And I personally think that interest rates are going to stay higher longer. I know some people think that you'll see, rates start coming down the end of this year, early
Think,
next
hope,
year.
whatever it is.
Yeah, exactly. Wish, but I personally don't see that. And so, when we buy MSRs, we've done probably more MSR transactions than anybody. We've done more transactions with individual institutions, and so we have a real knowledge about, how we would expect that MSR to behave. Like, what do we really think is going to happen from a prepay standpoint? What do we think is going to happen, from a delinquency standpoint? So I think that's another advantage that we have, is just the experience we've had in the market over time.
So there's two industry trends that we've been watching. So over the last several years, we saw independent mortgage banks start to build their servicing portfolios when origination volumes were growing quickly. And in the last year, we started to see them release some of those servicing volumes as they've been hunting for cash flow, or whatever the reason may be. And I imagine that's part of that 4 trillion that you kind of forecast will come to market in the next few years. How do you think about IMB's appetite to retain or release servicing, or any insight you can provide into the decision-making process of a mortgage bank leader on when they retain and when they sell?
Yeah, I think you probably hit the nail on the head. I think ultimately it comes down to economics, right? When you're in this type of environment where your origination margins are very thin, in some cases, you're not profitable at all, and you're certainly not cash flow positive. I think that drives the IMBs to look to sell the servicing, right? It's just the fundamental economics of the business are really driving that behavior. And that, to your point, that's where we see, massive opportunity, both from a legacy standpoint, so where they did retain in the past, as well as the current production. And I think it's pretty much that simple. I mean, it's just very difficult to retain servicing in this type of environment. If you're not making a ton of money in originations and you're not generating positive cash flow.
Do you think it's a smart strategy though? Like, if you're a originations focused mortgage bank leader, the servicing portfolio is gold. Like, that's the recurring revenue of the mortgage industry. So like,
Yep.
if I'm running a big retail mortgage bank, is it just smarter to like cut to the bone on the origination side and keep the servicing portfolio? Like, how do you think of that, like, from a business strategy?
Well, obviously, we're all about the balanced business model. So from our perspective, we think the balanced business model is the right way to go. We love it. And to your point, in this market, in this environment, we are, the servicing business is just it's amazing. And so, yeah, I think if you can retain the servicing, I think that's the wise choice, because when you're inevitably, we're going to enter a cycle like we're in now, and that's going to really be, your anchor to kind of get you through that. Now, I would say, for some originators, servicing's not an easy business, right? Servicing is a pretty complicated business. It takes a lot of investment. You need scale. And so, I think for some, operators and originators are like, look, I don't want to deal with that, right? I really don't want to make those investments and continue to have to make those investments. So I'd rather just stay in my lane. And when times are good, I will originate. And when they're not, I'll hunker down, sell the servicing, and try to make it through to the other side. But having a choice, I think you certainly want to keep the servicing. It just makes sense to me.
The other big trend we're watching is the activities of depositories. I recently had Lee Smith from Flagstar on this podcast, and he talked about some of the advantages of their recent acquisition by NYCB and what that's opened up from a balance sheet perspective. And as a leader of a mortgage bank inside of a depository, Lee has some strong views on the advantages of being a bank in the mortgage industry. How do you think of banks' positions as originators or holders of MSRs? I think that's a trend that we'll see. Like we saw kind of a reversal, right? Where the banks weren't as active in mortgage. Do you think that's a trend that will reverse itself and we'll see more activity from the depository side?
I do not, actually. I think it's you'll see the trend continue where mortgage will certainly be a product, but I don't think you're going to see significant investment in MSRs. I don't think you're going to see, significant investment in their servicing platforms. I just don't see that trend reversing. And with the new proposed capital rules, I think that only exacerbates, the issue and will lead more institutions to start thinking about, hey, we probably need to sell some MSRs. So that's if you think about when we think about the 4 trillion, obviously a big piece of that's IMBs, but we also think, we know there's a couple large institutions selling MSRs as we speak, and I think there more will join that list.
Go a little
I think
deeper there. So we've
100%.
talked about the Basel regulation, but like what are the new capital requirements that could make banks less active as originators or servicing companies?
Well, I think when you look at, just adding, I think it's 15% additional capital overall. I mean, that puts, a lot of pressure on the banks, right? They need to raise more capital. And when they start looking at, the assets on their balance sheet and the capital treatment of those assets, I think mortgage is going to be top of the list of one that they either want to sell or they want certainly to do less of. And so, and then when you start looking at kind of the way that they've sliced up, the different capital requirements for the LTVs of the loans, I think, again, that's going to lead to some different behavior in what they retain and what they sell. And so I think it's, again, the overarching theme is there's going to be more pressure to sell MSRs, in my opinion, than not. I mean, and we're starting to see more traffic, I would say, in as we look at MSRs to acquire. You're starting to see more banks come to the table, not with giant portfolios, but it's almost like they're, testing the market. And then as we have chatted with some of the larger institutions, I think, we'll see. I think they're waiting ultimately to see where the capital rules settle out, but I think the bias will be towards selling.
Well, that gives me a lot to think about because I feel like there's a rhetoric out there of depositories becoming increasingly attractive. One of the reasons for that is jumbo. So like we've seen property values appreciate so much in certain parts of the country. If you're on the coast, like a qualified mortgage is almost like non-existent in some cities. Like you need jumbo. So if depositories are less active or not increasingly active, how does the jumbo market get served as we look out through the next few years?
I think that may be an area where you see banks stay involved, right? And maybe some get more involved. So that I view that as an exception to, what I just said. And we really don't travel. We don't travel in the jumbo space that much. It's not a real focus of ours. But to answer your question, I think the banks will still participate in that market, although it could be to some lesser degree. And if they, choose to move away from it, you'll see what you see happen all the time. You'll see, originators come in. You'll see the securitization market, come back in a more material way. I think that's how that market will ultimately get served. And you are starting to see more activity there from, even some, non-bank entities. So I would put that in a little different category than, what we just talked about.
Okay. So Jay, we're in the beginning of what appears to be a relatively active hurricane season. And hurricanes aren't the only natural disaster that's been impacting homeowners across the country. Can you give us a glimpse into how you think about homeowners insurance, how that impacts servicing portfolios and your desire or appetite to have loans based in high risk areas like South Florida, who's, going through another hurricane as we speak with flooding issues?
Yeah, I think it's a great question. And I was talking to a very large financial buyer recently, and one of his larger LPs had asked him to do a pretty exhaustive environmental study, on the portfolio, and to really start thinking about some of the trends that we're seeing now and how that's going to impact performance, how that's going to impact losses, et cetera. I mean, for us, we have, the insurance piece is obviously critical when we buy the servicing. And then we also have relationships with insurance providers. In the case the homeowner loses their insurance or they can't get their insurance, we have alternatives for that. It's obviously in some cases more expensive, but it's something we monitor closely. We have third-party firms that monitor closely, and I think it's a trend that's worth spending a lot more time on. And when what we typically pay a lot of attention to is, timelines within, not necessarily insurance related, but what are the foreclosure timelines and some other things, within the different jurisdictions and states as well. So,
because whether it's lender placed or borrower placed insurance, if the cost of insurance goes up, it puts more pressure on the homeowner, which could put pressure on an earlier prepay because the borrower decides they can no longer afford to live in that location due to the insurability, or default risk because they can't afford to make their insurance payments or lose the house in a natural disaster or some other reason. It's like increasing insurance costs, not good for servicing, right?
no, not good at all. And again, something we're paying attention to. The other, I would say for our portfolio, we're predominantly Fannie, Freddie, kind of Ginnie. So, our average, we don't do a lot of jumbo. We're not really heavily exposed on the coast, just because of the nature of that. And, but yeah, that's certainly not good. And it's a trend that we need to spend more time on and should spend more time on.
All right, Jay, I can't thank you enough for your generosity today, sharing your time and expertise. I'm excited for Roosevelt. We're gonna be watching closely and see what y'all are able to do with that RIA capability.
Yeah, I'm excited too. Look, thank you for the time, Clayton. I mean, it's been great spending time together. I look forward to talking in the future, and I'm certainly happy to update you on Roosevelt as it unfolds.